Let's talk about the business of banking. This information is going to be helpful for you later on when we go over government intervention in the economy and how the Federal Reserve System increases and decreases the money supply in the economy to avoid inflation and recession. Okay, we're going to keep this as basic as possible. Let's assume that this is our bank or any other type of financial institution. We're going to have two main players here. Joe, who is going to represent our depositor, and we'll have Amy, who is going to come into play in a little bit. Joe is going to have two different types of accounts in this bank. He's going to have a checking account and some type of a savings account. His checking account is going to be where he deposits his pay, which, after taxes have been deducted, is called his disposable income. He deposits it in his checking account for the main purpose of keeping it safe. Periodically throughout the month, he will be making withdrawals from this account in order to pay for his various expenses, both fixed and variable. This could include his rent, grocery bills, gas for his car, etc., and he can make these withdrawals through the use of his debit card, through the ATM machines, through writing checks, or for simply walking into the bank and making a withdrawal. The money that is in here for a very short term because it's going to be withdrawn daily. Therefore, it is not going to earn very much interest from the bank because it's not going to be sitting there very long. On the other hand, there is very high liquidity because he can access his funds and convert the money in the checking account to cash very easily. Let's assume that Joe also has a savings account, and we're going to pretend this is a time deposit. Joe deposits into this time deposit periodically, let's say twice a month, because he's saving for his retirement and he wants to make sure that it's earning interest, maybe over a 30-year period. He cannot access this money because he is promising that he's going to keep it in there for a certain amount of time. Because of this, there is very low liquidity. If for some emergency Joe needs to access this money, he's going to be paying a large penalty fee. But because he's probably not, we assume that it has very low liquidity. He cannot turn this money back into cash easily until the 30 years are up. These accounts earn higher interest. Now, the reason why the bank offers higher interest for these types of accounts is because the money that Joe and all the other people who have different time deposits in our economy, that money is used to loan out to other customers like Amy, who might be coming in for a loan to expand her business, or for a loan for a car, for a house, for college education, etc. Amy will be periodically paying back this loan in monthly payments plus interest. The interest in this case is money that Amy is losing. A portion of the interest is given to Joe, almost like a thank you from the bank for letting us use his money to loan to Amy. And the remainder of the interest goes to the bank itself and serve as the bank's profit. Many times I'm asked by students, well, what if Joe's 35 years are up and he wants to access the money in his time deposit, but Amy hasn't finished paying the full amount back? You're not matched with a depositor and a loaner. All of the money that is in that financial institution's accounts for time deposits is hypothetically put into a big pot. And so if Amy's not done paying that back yet, there's many other different time deposits for which the financial institution can access to make sure Joe has his money, and then it's the bank's responsibility to keep records of this and make sure that whatever other accounts money was taken from, that money is returned. Because of this, you can put the relationship between interest rates and dollars into supply and demand curves. Let's focus on the one on the right. Instead of price being on the left, we have interest rate. And instead of quantity being on the bottom, we have dollars. And our supply and demand curves are still flowing in the same directions. The demand curve is not shifting. But let's pretend that the amount of money that people are putting into these savings accounts is going to increase or decrease. When the amount of money that people like Joe are putting into time deposits and other savings accounts increases, then the number of loans that can be given out to people like Amy increases. But when people start saving less, maybe because there's many layoffs and people don't have extra money to be putting into time deposits and they have to cut back because they have to pay for their expenses and that's all they can afford, then that means there's going to be less money available to loan out to people. When you put this on the supply and demand curve, if the amount of loans and the supply of loans increases, you see that our curve shifts from its original position to the right to show an increase. You can see that interest rates that are charged on those loans go down because there's an abundance of loans available because more people are saving. But if the amount of savings available goes down, hence the shift to the left, you could see that the interest rates that banks charge on the limited amounts of loans available increases. So when you see that banks are increasing or decreasing the amount of interest that they charge people like Amy on loans, one of the reasons that this happens is because the amount of savings available is increasing or decreasing. So when Joe decides to save, and he overspending, maybe because of inflation rates or because of higher interest rates on time deposits, it's not only affecting his short, medium, and long-term goals and his savings, it's also affecting what we call the loanable funds market, which is the funds available to loan out to people in this market over here like Amy, who want to borrow money. They're going to talk about this later on when we are discussing the health of the economy and how to manipulate the money supply. But if you understand this at this point, then you are in very good shape.